Good morning, everybody, and welcome to the Daily Energy Markets podcast. It is 10:30 UAE time, 10:30 a.m. That is, in case it might be 10:30 p.m. in other places. Brent crude oil this morning trading a little bit down after its massive surge yesterday. Now down at 69.23. But who would have thought when we stood here yesterday morning that we would be knocking on the door of 70 only a few hours later? Yesterday, we thought that the driver to 70 might come on the back of the China-US trade talks that seemed to conclude in London with some positive outcomes. But as the day went on, it seemed many things were contributing to that 5+% rise in oil prices. Let's go straight across to late night TV in America. Mike McGlone, senior commodity strategist at Bloomberg Intelligence. Mike, what has been, do you think, the main driver of oil prices now, right through the 60s, from the kind of only in a month we had dropped below 60 on Brent, and now we're knocking on the door of 70? What do you think is the single most important driver of that, and obviously yesterday?
Well, it's the macro. Hey, Sean, it's the macro cycle of seeking a low price cure. So we use the nuances of. I like your poll. Maybe it's something to do with the U.S.-China trade agreement. Maybe thing with U.S.-Iran. Maybe with OPEC. But it's all a classic example of a bear market, and we've had a bounce. Now it's getting near that 200-day moving average in Brent, which is around $72 a barrel. But virtually every single moving average, if you start at 20 days and go out to a couple months, they're all heading downward. So it's a bear market. We've bounced. And the question is, how high can it go? The thing is, crude oil is not isolated. I see very similar trends in iron ore and the grains, corn, soybeans, and wheat. And they're all on the back of that big pump in prices that incentivize that supply, cut back on demand, and now we're heading towards that low price cure. So the key thing is what stops it. Typically, you have to get below the low price cure. In the U.S., it's the cost of production is between $50 and $55 a barrel. In the last 20 years, it's basically had to get down below around 40. Now that's using WTI, so add a buck or two for Brent. So to me, this is all the macro cycle, and the key thing is all being elevated by the key thing that has to happen is U.S. stock market has to stay elevated, and that might be rolling over to a recession. So I see crude oil is just a bear market bounce for now. Is there going to be a major shift in the supply-demand balance? It's unlikely. Typically, you have to get below those costs of productions and stay below for a while, and we're just heading there for now, and this has been a bounce.
Kate Durian, a Mies contributing editor and non-resident fellow at the Arab Gulf States Institute in Washington. Kate, a lot of noise yesterday about language, saber rattling, if you like. We've heard it from the Trump administration for months now that if Iran does not behave itself, doesn't come to the table and offer up all that America demands, then they will face a military consequence. And we had yesterday, it would appear, Iran responding to that, saying, well, we have the ability of military response of our own. Is this just rhetoric, an overreaction from the energy markets, U.S. Embassy maybe moving out three people and their dog? Your thoughts on this is a kind of a geopolitical moment of crisis warranting 5% push in the oil price?
I mean, I was watching the market yesterday, and I think that's a big part of it because, when you get this sort of talk of escalation, when you have a phone call between Trump and Netanyahu a few days ago, and God knows what was said then. But even if Trump says, I told them not to attack because I want a deal, then at the same time he says, well, we may not even have a meeting on Sunday. So, it's looking but a lot of it is rhetoric. I mean, you can't take what they say in public when there's negotiations going on, but it doesn't look like it's going very far. But it's worrying when you see these reports that the Americans are pulling some non-essential staff from Kuwait, from
But
Bahrain.
usually you would take all that rhetoric, put it in the weighing scales as you want. But ultimately, a 5% jump, you would say, only really happens on such rhetoric when it's a really, really tight market. Not when OPEC is massively increasing supply into a demand weakening environment. Those two just don't seem to go together.
No, I think it is it is a pretty tight market. I mean, let's face it, and it could get tighter still. You know, you've got more sanctions coming. Remember, the EU's discussing these new sanctions on Russia, lowering the price cap. You've got all kinds of threats coming from pro-Iranian militias in Iraq saying they're going to attack American interests. It just there is such a if it happens, I think you've got to hedge against it because you can't just say, oh, it's just rhetoric because it may not be state, players involved. It could be other smaller players. I mean, it's just going to inflame the situation in the Middle East. So I think it's not looking very positive at the moment for the talks. It's not looking positive for the talks with Ukraine between Ukraine and Russia. We've got G7 coming up, and I heard that Trump tried to get Ukraine off the agenda. It's not looking as if even the big powers are going to be on the same page on a lot of these issues.
Osama Rizvi, energy and economic analyst at Primary Vision in Pakistan. Osama, your thoughts generally on this bigger picture idea? I mean, yesterday we had this big move in the oil price, but it was on top of moves incrementally over the last few sessions once China, US appeared to be finding another sort of rapprochement for however long, ultimately not getting worse in the trade tariffs between China and the US, getting better. And then we had this Iran-US language. Your thoughts on what are the sort of fundamental driver here, getting Brent crude up to $70 a barrel?
Well, thank you so much, Sean, for having me today. I believe there are a lot of elements right now, both bearish and bullish in the markets. And, being an analyst or a trader, you can just, pick and choose. However, certain elements such as these geopolitical flashpoints, they tend to take the front seat. Fundamentally, I believe that the oil markets are bearish. And there is a lot of reason for that. You look at the inventories, you look at the non-OPEC oil production, you look at the discrepancy between the oil demand and supply. You look at the global economic prospects report recently released by the World Bank. All of them point towards a bearish oil market. But these geopolitical flashpoints, I think they may provide some temporary support to the oil price. But we really need to see that whether these will, and hopefully they will not, but these will materialize or not. I think so far it's rhetoric, it's saber rattling, as you said, but with the recent events, you never know. I mean, there are reports that Israel is ready to launch an attack on Iran. Iran says we will give a proportionate response. So that is a cause of concern, especially when you have people moving out of the region. And it's a wait and watch thing. But if and when it settles down, I think the direction for oil markets and oil prices is on the downside.
Mike, just looking at the kind of the position from Trump as we go into, I mean, you got the G7 issue at the end of this week, but you have the bigger picture issue. It seems to me the big budget that's they're trying to muscle their way through Congress with. A lot of things seem to me a strategy of distraction. Don't get the media, don't allow the media to really drill into this big budget bill because there's so much toxic stuff in it. Let's keep them busy with all this noise on the sidelines. I mean, from a US perspective, is the big, beautiful bill, whatever one calls it, getting the granular sort of scrutiny that obviously a bill of that scale deserves? How do you see all these pieces coming together, the domestic agenda versus all the other noise?
Well, the one thing that we're quite impressed with is Trump's desire and ability to be on the tape in your face every day. He does that very well. So a lot of it's deliberately ignoring. So the key thing matters to me is what matters for markets, for oil markets. And Osama said it well. So we're in a bearish market. And we're getting flashpoints giving bounces. I think virtually every trader on the planet gets it. And it's not, as I point out to me, it's not just crude oil. It's also the elastic commodities, the grains. They're all looking for bounces to sell. We've just had a decent bounce in crude oil. WTI has gone from 55 to 65, right? Or 60 and change, 67, maybe 70. It's a question of how high it goes. The key thing, the bottom line, though, from the U.S. standpoint is, most economists were looking for a recession in 2023. We didn't get it. Now we have one of the best incentives ever for that recession. A lot is mainly tariffs. So my colleague Gina Martin Adams, our chief equity strategist, estimated that cost of goods sold for S&P 500, about 40% of that is on imports. So that's going to be a major shift in costs. It's going to really hit corporate profits. And that is the most significant thing to me in all markets, is because the U.S. stock market at 2 times GDP, there's only 2 times in history we've had markets that high, 1929 U.S. and 1989 in Japan. They have to keep the stock market elevated in virtually everything they say. They try to do that. But I think the risks are it just has a normal downward trajectory and heading lower. So we're seeing those deflationary forces, which is normal after inflation. In China, 1.7% is their 10-year note yield. That's a significant deflationary force. In the US, it's about 4.5%. And it's only how long we can stay elevated. So crude oil is showing that deflationary force. The grains are showing that deflationary force. And the US shift, the government is trying to keep things elevated, but I think the risks is we head towards that normal cycle of a recession. And I don't know if they can do anything to stop it, but what's happening with all the rhetoric, it's making people, the quote I heard is, if you're driving, put in on their hazards and pull over to the side and just wait, which means somewhat of a recessionary bent to me. So that's the next big shoe to drop. If we can stay elevated in US stocks, that's fine. But I look at what's really happening in commodities, gold taking off, crude oil going down. That's a major global recessionary trajectory. And I think from a US government standpoint, the Trump administration is getting a little bit of a pause right now. But as we head towards those lower, the tilt towards what's really happening with consumers shutting down, and our economy is looking for a bit of recession, to me, that's the bigger macro. And we might have had that decent bounce in the stock market that's rolling over now.
Kate, one of the points, as you mentioned in your earlier comment, this is a tight market. And we had commentary earlier in the week that despite these production or these OPEC plus or the 8 countries within this agreement raising quotas each month over the last few months, it actually has resulted in no new barrels because they're simply raising quotas up to meet an already existing production level. So the softness that we saw initially on these announcements didn't translate. The opposite, prices climbing because there's actually no new barrels. It's simply a paper quota increase up to meet the already elevated production. Your thoughts on that, and where does that go forward?
I think part of it is yes, the overcheaters. We've got Iraq is trying to comply with its quota, but not going that far. We've got Kazakhstan, which is not going to comply because it doesn't really have control. But I think it's if you look at the demand projection, yesterday when I was looking at the World Bank report, I counted, and it shows you how much time I have on my hands sometimes. I counted the word uncertainty was used 228 times in 138 pages. I mean, that is a lot of bloody uncertainty. That sort of, how can you make any projections? How can you tell? And also, I think all of these tariffs, I mean, these are tariff talks. They're not really trade talks, right? Because you're not dealing
But back
with
to the point of OPEC plus,
Yeah, okay.
OPEC plus are just increasing quotas on paper. They're not actually adding additional supply yet, at least on these increases, and hence the
Not very
tight
much.
market. Your thoughts on that?
Well, not very much. And you and I have covered this for a long time. And you know that a lot of these countries can't even meet their quotas. So I think if you look at the numbers and you look at the demand projections, which are mostly, I think, below 1 million barrels a day for 2025 before they pick up, I think, it's hard to see this sort of bounce from yesterday. I don't understand it. I mean, I look at $70 plus and I think, why? There is no reason for it. It's a tight market, but there's enough supply. Even Libya is managing despite all the troubles that they have. You've got Guyana going up again. They're getting close to over 1 million. And they're going to be shipping more oil. So I think it's not that tight of a market. I think it's fairly balanced, but a lot of these countries can't produce even at quota. So there isn't really much scope to sort of add much more oil.
Osama, looking at the geopolitics here, I mean, going into the G7 meeting, and we have what we heard yesterday, the Iran-US rhetoric sort of boiling up a little bit. But at the same time, we've got news out of Israel that there seems to be movement underway for lawmakers to vote on an early election that would sort of see Netanyahu getting perhaps removed from office once again, and the G7 meeting coming together with all significant kind of leaders, including India's Prime Minister, the leader of Saudi Arabia, the Crown Prince, and so forth. Where do you see the geopolitics on the wider level, and then here in the region, the talk about war?
Well, that's a very interesting question, and it touches a lot of points. So, on a bigger picture scale, I believe that, and this trend has been going on for the past few years as well, especially post-COVID and post-Russia-Ukraine war. You can see a divergence, a clear line between the changing world order. That term is overused, but there are new alliances building up, and they're strengthening. They're getting closer every day. So the Eastern Hemisphere and the Western Hemisphere, there seems to be a line drawn between them. You see that in the wider picture, in the bigger picture, in the bigger scheme of things, I see Pakistan. I think Pakistan and the Southeast Asian countries getting closer because of the fact that ASEAN and China is, the largest trading partners among themselves, whereas India and US and the US allies in the region will form. You'll have a de facto coalition there as well. So I see a lot of divergences, and there is a really interesting term called mini-lateralism that explains the geopolitical front at the moment, which is that countries would be working together on certain issues, and the same countries would not be agreeing with each other on other issues. So it's the age of mini-lateralism. We are seeing countries looking inwards. We are seeing countries becoming selfish. You can call it nationalistic. And the energy markets is the best example of that. You have Russian oil being welcomed by all of these countries: Pakistan, India, Turkey, Malaysia. Essentially there has been a fall in oil and gas revenue, but only this year. And I don't think, I did some study and calculations, it is not primarily because of sanctions. It is primarily because of the fall in oil prices. So that's where I see these things. In terms of the war, I hope that we don't see one anywhere across the world. We literally can't afford it. But when we talk about specifically the two big players in this region, Pakistan and India, both nuclear powers, I think that the recent battle or the skirmish might be, and I'm very afraid to say that, might be the new norm here. And if there is any attack, without any evidence, the countries can go to war or, act out militarily, which is not a good precedent, I believe.
Yeah. Let's go to the survey question and take a view on the theme that we've been talking about, which is ultimately, what is the big driver here? What is the top driver pushing oil prices to $70 a barrel? And then hence, in the answer of that, what could that reverse? The Iran-US war talk, tomorrow we wake up and it's the opposite. Trump loves Iran again, or the opposite. China-US trade pact is really a box that nobody can see inside. They've agreed, it seems, on something, but no details. Essentially, it seems we're back to where we started. China has given up really nothing, and the US has climbed down again. This idea that anyway, there's a trade pact, and that has triggered the animal spirits. Strong summer demand. Mike's out in he's put his electric vehicle away for the summer and has taken out his RV and is driving on four gallons a mile. And so summer demand is up, or OPEC is simply not adding any real barrels. That's the driver. Despite these quota announcements, that is not actually adding any new barrels. So what would be the top driver pushing oil prices to $70 a barrel in that pace? Mike, looking at some of the US sort of fiscal, monetary issues as guidance going forward, the Fed appears to be paused despite the challenges of Trump, and inflation seems to be signaling positive noises. Where do you think the macro outlook, particularly in the US economy, is for the politics of passing this big bill, the Fed's remaining on pause. Are all the green lights on for that?
Well, I think that's the key thing. We've reached a bit of an end game in the U.S. wealth creation machine. Now, you can certainly see it in the dollar. Most measures of the dollar, trade-weighted broad dollars, down about 7% on the year, despite the fact U.S. stock market has recovered. Yet they've been the same trade since the bottom in 2009. And I think most people get it. You're selling U.S. assets, certain U.S. equities on bounces, and I get the sense a lot of U.S. investors are doing everything they can to offshore their expensive dollars and expensive stock market. And so the key theme in the U.S. is how much higher can we elevate these risk assets? And the most significant, I think, indicator has been this U.S. Treasury 30-year long bond. In May, it reached a high of 5.15%. That's the same time that Bitcoin made a new high. Now it's at 4.90. And today we have a big 30-year auction. I think most people are realizing you can lock in 5% for 30 years. Why would you bother with the U.S. stock market? So to me, that's the big picture macro. It's this most expensive U.S. stock market versus the rest of the world and versus GDP in about 100 years has to stay elevated, or we get that normal cycle towards deflation after the inflation. Now, you're obviously seeing that in crude oil and you're seeing it in most grains. So the question is, how much longer can U.S. remain elevated? And I think that's the key thing, was watch those bond yields. And I think the risks is they head lower. But here's the problem is we've elevated risk assets so much. The Fed made the mistake of easing more last year when the bond yields were going up and told them to stop easing. It means they can't really ease until the stock market goes down and alleviates a lot of that wealth effect, which is creating the inflation. And we're going to have sticky inflation from tariffs and things until, and probably unless, U.S. stock market goes down. You see that normal tilt towards normal deflation? That's my point. It's already happening. We're all turning Japanese. It's certainly happening in China. And the question is, how much longer can U.S. remain elevated? So I'm really still towards a bearish outlook for crude oil, bullish for gold, and much more very defensive on the U.S. stock market. I don't see how much longer we can remain elevated. And once it rolls over, that's a pretty significant deflationary force, which leaves gold and long bonds as some of the best potential performing assets. Now, gold this year's up about 30%. It's a little bit expensive, but if the U.S. stock market just has, let's say, an 8 to 10% down year, that'll solidify gold to get above 3,500 an ounce.
Kate, on the point of where additional supply is going to come from, you mentioned in your earlier comments that a lot of these OPEC plus countries are producing at near maximum. All indicators would appear that the OPEC 8 or OPEC plus 8 are going to continue with this accelerated quota increase in July again until they sort of bring back all of this 2.2 million. Where is there actually going to be new supply? Will this result? There's a lot of forecasts that the oversupply will manifest itself in the headlights very clearly in the third quarter, where in a way that it hasn't in the second quarter. Where's your outlook on that?
As I said, uncertainty is a word. I don't think we've seen the impact of the trade, the trade disputes yet on the US economy. We haven't really seen, it's going to take time. But I think on the OPEC front, I think we are going to see a slight dip in US production. It's slight, but it's a slight dip. You've got fires in Canada, which have knocked out. I mean, all of it seems to be very sort of, short term. But, demand is supposed to pick up a little bit next year. It's not going to be, we're not going to see pre-COVID levels. I think China is key, obviously. India, but, India is not as big a market when it comes to crude oil imports as China is. I think China is key. US production declines, Guyana comes up. And, let's not forget, it's really, the story's not so much about oil these days. It's about gas. I mean, look at how much the GCC countries are investing in acquiring gas assets. And, coal is, once oil goes up, you're going to see more coal. So you need that gas to sort of to displace that coal, or we're going to go through the roof. You've got nuclear, you've got the US, the Trump administration is going to facilitate investment in new nuclear power because of AI, because of Bitcoin, because of all these demands on energy. So I think, oil might at some point take a back, a sort of a secondary role to gas. I think the story these days is more about gas than anything else. But I think the impact of the inflationary impact of the tariffs we haven't seen yet. It's going to take time to filter through. And if you're going to reduce rates, I think you have to wait for it to stabilize, And with all this uncertainty, it's really difficult to see how the Fed can actually say, oh yeah, okay, so core inflation's down. We're going to reduce interest rates. We're going to cut interest rates, and that's going to help with repaying the debt and all that. But I think the Treasury auction is going to be very interesting to see what kind of interest there is, and I don't think there's very much trust at the moment in T-bills. So.
Certainly not 30-year ones, you would think, maybe, 30 months. But Osama, looking at this sort of context of things in the midst of this trade war, what we are in this suspended period of the reciprocal tariffs, we're getting to the end of that 90-day window, and we have Trump announcing yesterday that he will unilaterally, they're not going to negotiate, they're negotiating with the Chinese, and it doesn't seem like it's much of a negotiation. Ultimately, the Chinese said, listen, we don't want to play this game. And America said, okay, we'll take our ball away and leave it at quits. But ultimately, everybody else who can't stand up to the Trump are waiting now for what will be a unilateral decree of King Donald to the world. Your tariff is going to be X, unnegotiated. This is the number. How does Pakistan brace for that? India, Asia, where do you think that goes? What's the expectation that that's going to be a April 2nd type punch in the face, or will this be a taco like Trump always climbs down?
Well,
Chickens out, I think.
Yeah, I think when we look at the regional growth and the recent forecasts, minus India, India's growth is really impressive. But minus India, World Bank says the growth might inch up 3.4% or 5% in South Asia, and getting a little bit higher in the next year at 4.4%. This region faces a lot of issues right now: uncertainty related to tariffs, then weakening currencies and high public debt, and of course geopolitical risk. And in the midst of that, I think Pakistan is bracing for a tough year ahead as well. Recently, we announced our budget. The budget was same old with little tweaks, nothing new, no bold
So what,
reforms,
Trump
no
tariffs are
structural measures.
essentially the least of your worries? I mean, you've got
Yeah,
you've got to
yes,
get bread on the table today, not
that
tariffs next month.
that's there, and I would say that Pakistan is also trying well in diversifying its trade portfolio, especially with the Central Asian countries. And we were discussing non-OPEC production in Kazakhstan. I don't think like countries in Central Asia are going to, especially Kazakhstan, going to reduce their production, because when we talk about the Road and Belt Initiative, the Kazakhstan is the buckle in that belt. And that country has a lot of domestic priorities that they want to meet. And like Saudi Arabia, they will need higher oil and gas revenues. So that's the OPEC plus side. But yeah, for Pakistan, there are more concerns, domestic concerns. Tariffs will obviously impact us. But with a $6 billion surplus with US, we are trying to buy more from the country. There have been recent talks, and we might be able to rationalize it to a level that we might not face the ire of Trump.
The ire of Trump. It's nearly a kind of a Shakespearean drama. To me, it's all just noise and distraction from the big budget bill, in which there's 1,200 pages of rape and pillage in the US economy, and everything that distracts from that is a win for Trump. It gets on the headline something other than what? You're doing what? You're having tax cuts to who? You're giving powers to who? Oh my goodness. Nobody's talking about that. They're just talking about silly nothing tariffs that are nothing burgers in the end, and they end up being back where they all started. And not a coincidence, in my opinion, that this 90-day event ends just around the same window as the budget bill passes or attempts to be voted on in the Congress. Distractions every which way you turn, it seems to me. But nonetheless, Iran-US war talk in the meantime will keep the oil markets on edge and keep the oil price popping up in the closer to 70 than 60. China-US trade pact also coming up on the inside lane, giving some extra momentum. Strong summer demand. Even if Mike is in his EV, there's others who aren't, many others. And OPEC not adding real barrels. Nobody's interested in that answer except for a few. We'll leave it there. Mike McGlone, as always, thank you so much for joining us in the wee hours. Osama Rizvi in Pakistan. Great great to have you. Kate Durian here in the wonderful town of Dubai, alongside me. Not quite, but I can see her across the hill. Kate, thank you so much. All the best. Have a great day, everybody.
Thank you.